revenues from contracts with customers. So this accounting standard replaced IAS 11 and IAS 18, where previously all accounting standard they describe how we are going to record the revenue and how we are going to dealing with contract with customer separately. And this IFRS 15 they are more holistic, combining both the standards and use it for all the industry across the business world. So it can be include small business without a formal contract that is just involve a verbal contract, or it can be involve a big contract such as developing building. So in IFRS 15, the jargon here will be the 5 steps models. So these 5 step models, accountants will follow it to record the accounting's revenue. And in here, 5 step, the step number 1 is the most essentials, whereby we will need to identify a contract from the sales. And to identify contract, it is makes sense that we must have at least 2 parties, offer and acceptance. So the contract can be in written, can be an implied terms. Written meaning to say there's a black and white on what I'm actually selling to you and what you expect to get the items and how much you need to pay. And implied contract is non-written, meaning to say it is verbal. So in this case, I go to the restaurant, I say I want a plate of fried rice. Then the restaurant owners will just give us the fried rice and collect the money from us. This is an implied contract without formal black and white. And both parties must be approved. Like for example, I tell the parties that I want to have a fried rice, or I buy a big project, I want to buy this condominium, another party will sign on it. Or when I get the fried rice, that is actually implied terms that the sellers already complete, so-called the task to all of us. And both of them approve, and there's a legal enforceable rights and obligations between the parties. So the rights and obligations, for example, buyers always have the rights to get the product, but they have the obligations to pay. Sellers, they have the right to collect the money, but they have obligations to deliver the goods and services. So in this case, both of us right and responsibility able to identify, and consideration is able to establish. Money I can give as a customer, seller they can give the product. So these are the considerations exchange. And if we can conclude this is my contract, and we can proceed to the next steps. Next steps will be the identify separate performance obligations, PO. So performance obligations means the promise that the sellers want to transfer to you. And this promise must be distinct. Distinct means we are able to separate from other performance obligations. For example, if you are able to identify a contract, and this contract is a sales and purchase agreement buying a condominium. If I tell you item number 1, condominium, item number 2, a parking lot, and the total price will be 650k. So this contract, you sign on it, therefore it is a valid contract. However, when it comes to identify performance obligation, what is this? And the performance obligation is this too, because we are being promised that we can get a condominium and we can get a parking lot. So there will be 2 performance obligation, or in layman terms, 2 promises, and they are distinct. They are separate from each other. However, if I were to give you a detail in this way, 3 bedroom, 1 living room, 1 kitchens, and 3 bathroom, and 1 parking. In total, 650. Does it mean we have 5 performance obligations? The answer is no, because the keyword here must be a distinct promise transfer of specific goods and services. Must be a distinct PO. Distinct PO means one PO cannot take it out from another PO. Just now we were told that this SPA is for condominium. You're buying a condominium. And it makes sense that 3 bedroom together with 1 living room, 1 kitchen, 3 bathroom, that will be a complete set of a condominium. Therefore, all these 4 items are considered single PO. And this is very important when we are discussing our performance obligations, and this will be another second PO. And this is the reason why we will need to study step number 2, because if you didn't study step number 2, you don't know what is distinct. You will identify them into 5 different PO. Because a condominium without living room, without bathroom, without kitchen, without each of 4 leaders, they are not going to be a condominium. So we will tell the people that these few items is interdependent with each other to become a condominium so that we can stay. And this is based on commercial expectations. Therefore, one single PO. I give you another simple example, set menu. Set menu consists of 1 drinks and your fried rice, egg fried rice, and 1 dessert, maybe cake, and they sell at 20 ringgit. Does it means this is a verbal contract? Definitely we don't have a signing. We are just verbally accept and verbally offer. So this set menu, does it means we have 1 drinks PO, egg 1 PO, rice 1 PO, and cake 1 PO, total 4 PO? No, there are 3 performance obligations. Some peoples, they will argue that, hey, egg fried rice, egg is a performance obligation, fried rice is another performance obligation. The answer is wrong. The title of the name of the menu here already told us egg fried rice. Egg and fried rice, without mixing it together, they are unable to call as egg fried rice. Therefore, both of them are interdependent to each other to become one dish, and this is one single PO. So in total, there will be 3 performance obligations, and this will be the step number 2. Step 3. So step 3 is determine the transaction price, and this stage can be very easy, but there are certain things is exceptional exceptional items that we will need to remember. Step 3. So this is the amount that the value the entities will expect to receive from the exchange of goods and services, after discount, after rebate, and those other items. And I would like to specifically highlight these words, refunds. Certain items that we sell to the customer, they might subject to refund policy, meaning to say we are actually giving the customer a rights to refund if let's say they are not comfortable with the goods. So, and this particular refund policy is actually a performance, is actually an obligation to all of us. The reason because when we sell the item to the customer on 31st December 2026 example, and I tell the customer, hey, you are able to raise a refunds to me within 30 days anytime you are not satisfied with the goods. So in that case, 31st December 2026 that night, you recognize the sales, but are you going to sleep well for the next 30 days? The answer is no, because anytime when the customer not happy, they are going to come back and return the goods to us and seek for refund. Therefore, there is an obligations in the contract. And to do this, we will need to understand how we record the sales. So when we record the sales, we will debit our bank because we receive money, and we credit the sales. Example, we sell at 120, and my cost of goods sold, example, my cost is 100. So how I'm going to record this cost of goods sold? When we sell the items, my inventory will reduce, and this will effectively become my cost of goods sold, because the goods already go out, and this cost of goods sold is related to the sales, so that we can do a matching of these two elements in our SOPL. We will have sales record 120, we will have cost record at 100, we have a net profit 20 ringgit. So this is how we record sales. So we are trying to tell the people that some portions of this 120 or the entire portion of this 120 is something that you are going to have a risk of refund. So meaning to say customer might refund back to you, then return back the goods and you need to refund. So to do this, IFRS 15 step 3 they say, no revenue is recognized or a provisions for sales return is recognized, either one. Either one will give you the same result. If the vendor expect goods to be returned, meaning to say, immediately after you record the sales, debit bank credit sales, debit cost of goods sold, credit inventory, you know that this sales actually attached with the return rights, you will immediately need to record the sales provision by debit sales return to reduce your sales, can you see, and credit your provision as a liability. Correspondingly, when you expecting this particular sales will return back, you debit sales credit provisions. Correspondingly, you also will return back they also will return back the inventory to you. So you will debit. In this case, we not really in reality we not really taking back the inventory. We just need to put back debit provision for sales return, or you debit provisions for inventory related to the sales return, credit your cost of goods sold to restate back your cost of goods sold. Sometimes can be the entire 100% or 120, sometimes can be a certain percentage, meaning to say they can say 5% of this 120 could be returned back to the customer. So 5% of this, you will need to take the 5% of 120, so 5%. So meaning to say we are trying to tell people that this 6 ringgit is something that might be returned back from the customer, and 5% of 100 is 5 ringgit. So we will do like that so that we won't overstate our revenue and cost of goods sold until when the return policy is expired. Then 1 month later, 30 days later, you can recognize back this sales return by credit sales, debit provisions of sales return, cancel out the provision, and cancel out the provisions, credit provisions, and debit cost of goods sold related to these cost of goods sold portions. So this is how it works in real world, and this is also specifically in step 3. Step 3 also mentioned about significant components of financing components. So meaning to say, if today I give you a simple scenario, if you are selling an items at 200,000, and this is going to collect in 2 years time, how are you going to record the amount? You are going to debit your receivable, or we call it as contract asset because it's long term, and we are going to credit my contract liability. Or for example, you have complete the sales already, so we can record the revenue because accrual concept told us 200. But the thing is that this debit contract asset in year 0, now you record. In year 2, meaning to say 2 years later, when you receive the money, you debit bank, credit contract asset, 200. By right, it's like that. However, it might contain a financing components according to IFRS 15. If I'm telling you that the present value is 190,000, and this present value that actually gives us a future value of 200,000. So we discount 200k back to present 190, or we convert 190 future value to present value to future value. And the difference of 10K is time value of money, example. So if you are paying money in arrears, if customer is paying money in arrears, meaning to say one few years later they only pay us, we will debit contract asset. Since it's more than 1 year, we assume debit contract asset 200,000 example, and we will credit the revenue only 190, meaning to say currently if I complete the task, how much is my real value according to current present value. So even though you are charging 200 customer in 2 year time, but you complete the revenue now already, the revenue is actually worth 190 in the present value terms. And the remaining 10,000 will be the finance income as a time value of money components. So this is what IFRS 15 said. You cannot record it as the revenue because in this arrangement consists of financing arrangement. Or if it is a payment in advance, meaning to say customer pay now at 190 in the present value terms, you debit bank credit contract liability. So 2 years later, when you actually perform your revenue already, so you will need to debit your contract liability. There is an unwinding interest. For example, if this is present value 190, in 2 years later it will become 200 because from present value convert to future value will increase. So 190 become 200. So you debit your contract liability to cancel off your contract liability, and you credit your revenue 200. The difference in the debit side will be your finance cost. This is what we're trying to say. Customer actually paid you money in advance, and after 2 years time, there will be an unwinding interest because the real revenue in the future is 200K worth, but you only receive 190. So the difference is the finance cost. So this is what they say in financing components. However, IFRS 15 also say if the customer has the discretions over the timing of transfer of goods, so meaning to say if customer want you to transfer that in a 2 years time, maybe now or 3 months later, then these financing components we can ignore. We won't do that. And consideration is variable and amount of timing depends on a factor outside both parties' control. We cannot control anything. Then is maybe a legal things coming in, factors coming in or whatever, then we won't do financing components as well. Or the difference of the consideration and cash selling price is arise from performance protection. For example, I receive money from my customer in advance so that can protect me. I can start my work secure, very secure. Or the customer hold the money until the last payment, then only release back to me. That's why will result in payment in arrears. That kind of arrangement, we won't do any financing component adjustment as well because it's purely to secure the performance protection. Only without having these three assumptions, then that might be a financing components attached in the particular sales contract. Then we will need to do this adjustment. And step number 4, allocate transaction price to performance obligation. This will be allocated based on stand-alone selling price. So for the few items that we identified just now, example, going back to example number 2, we have this condominium as one PO, second PO parking lot, example. So if I'm telling you that my condominium I can sell at 700,000 and my parking lot I can sell at 100,000, so total is 800,000. So this is normal selling price. Normal selling price, we call it as stand-alone selling price. But in my contract, my transaction price is 650. So we are get certain portion of discount, 650K. So we will need to use this percentage of the stand-alone selling price based on the stand-alone selling price circumstance. If my condo stand-alone selling price is 700, if I sell it in without a bundle, I will receive 800K. So 700K divided by 800K, the proportions is 87.5% out of these two. So the remaining percentage will be, the remaining percentage will be 12.5% belongs to your parking. So to do this, we will need to use 650k times 87.5% and 650k times 12.5%. So you will get this amount, which will be amounting to 650. So our ultimate goal is to allocate this 650 into condominium, into parking, because their performance obligation is different. So the timing of recognizing the revenue could be different in step number 5. Maybe you will get a parking now, but you get a condominium later. Just an example, but in real world it won't happen. So we will need to identify the transaction price in this stage. So step 5, this stage, recognize revenue when each performance obligation is satisfied. So meaning to say, when we have promised, when sellers promise certain things they have complete already, satisfied already, then we can recognize the revenue. So recognizing the revenue can be over a period of time or at a point of time. So it will depend on the scenario. Meaning to say, condominium confirm is satisfied over a period of time. We will need to take a long time to complete the project. If you buy a fried rice, that is at a point of time. Meaning to say, you order the fried rice, you get a fried rice at a point of time. So this will be the two difference. So let's talk about the most simple one, point of time. Customer pay in arrears, so in latest, or customer pay now, we get the items later. So if customer pay in arrears, but we satisfied the PO already, we will recognize the revenue, because once PO satisfied, we will recognize revenue. So we credit revenue, we debit receivable, because customer haven't paid us money. When customer pay us, debit bank, credit receivable. Likewise, for advance, we receive the money first, but PO not yet satisfied. So we will debit bank, but credit income received in advance, or we call it as deferred revenue. Then only when PO satisfied, we debit the liability, the deferred revenue or income received in advance, and we credit the revenue. So this is in the normal point of time situations. But when it comes to over a period of time, that will be a little bit complicated. So pay in arrears means I complete the PO, but I haven't received the money. So I will debit contract asset, credit revenue. Okay, if so-called the contract over a period of time is less than 1 year, you can debit receivable. Normally contract asset, we give it to more than 1 year. So debit contract asset, credit revenue. And after I bill the customer, I will debit receivable, credit contract asset. Meaning to say, I recognize the revenue in PO satisfied, but I got a contract asset in SOFP. So when I bill the customer, this contract asset will credit and it become receivable already. And when I receive money, I debit bank, I credit receivable. Because sometimes you might have situation like this. You have complete 200k. And revenue, to bill the customer, maybe you only bill 100k. Because there's another 100k you're going to bill later. Okay? And you are going to receive the 100k. So you will gradually transfer this contract asset to receivable until it becomes zero, everything in your bank already. So this is pay in arrears case. If pay in advance, straightforward. When you receive money but PO not satisfied, 2 years later only you satisfy your PO, you will debit bank, credit contract liability. Okay? And when you satisfy, you debit contract liability, credit your revenue. That's it. So this is over a period point of time. When I explain this, doesn't mean contract asset and contract liability won't happen together. I give you an example. Customer sign a plan for 2 years. Okay, sign a plan for 2 years, and each month you need to pay 120 customer. So when sign the plan, meaning to say customer committed, we will need to debit contract asset 2880. Why? 24 months, 2 years times 120 per month. And we credit contract liability. So we didn't receive money. We haven't performed the services. So in that case, they sign only. And this customer signed 2 years 120 per month is actually paying in arrears. At the same time, we haven't given them services. So we debit contract asset, credit contract liability. So during the month end, every month end, when you bill to the customer, you will debit contract asset. Just now you debit contract asset, sorry. Now bill to the customer, you will credit contract asset to take out the contract asset here, and you will debit receivable. So meaning to say, on this date, your contract asset left with 2,760 balance in your contract asset on this date. If let's say you receive your money already, we will debit bank, credit, receivable. 120, 120. This is where if you receive money, if you receive money already, meaning to say we can straight away debit bank, and but this is the normal procedure. We will transfer contract asset to late receivable, and we will reduce by bank in the stage number 2 here. We will receive the money, and after 1 month, your PO already satisfied because you have signed a plan. Maybe it's a Delco plan. You have performed your Delco services. So that 1 month 120, you will originally you credit contract liability as your liability. Now you debit contract liability and you credit your revenue. You can recognize your revenue on this stage. And this will be mixing the contract liability and contract assets. So I hope you have get some idea on IFRS 15. Thank you so much.